The IRS just dropped the brand new numbers for long-term capital gains for 2026, and it got me thinking. We spent decades grinding it out, saving and investing, all for that magic number that lets us finally walk away from the 9 to 5 job. But what if I told you the government has a back door open that could let you retire early, completely tax-free? And I'm talking about a perfectly legal, powerful strategy using nothing but your regular old brokerage account. Now, let me show you the new IRS numbers and the exact hack you can use to retire early completely tax free, unless you like paying taxes.
Nah.
First things first, I'm the realist. And let's get the official numbers out of the way so we are all on the same page. The IRS just announced the long term capital gains brackets for the 2026 tax year. And remember, these apply to investments you've held for more than a year. So for 2026, single filers can have long term capital gains of up to $49,450 and pay a 0% federal tax rate. Now, once your taxable income goes above these numbers, you jump into the 15% bracket. For single filers, that's for income between $49,451 and $545,500. So if you make $50,000 in long-term capital gains, the first $49,450 is tax-free, and the remaining $550 will be taxed at 15%, or a total of $82.50 in taxes. That makes sense so far, right? And if you're married and filing taxes jointly, that number doubles. You can have long-term capital gains of up to $98,900 and still pay 0% on these gains. Think about that for a second. You can have nearly 100 grand in income from your brokerage account, and your tax bill could be zero. If your long-term capital gains go beyond these numbers, it's going to be 15% for earnings between $98,901 and $613,700. Anything above those amounts get taxed at the highest long-term capital gains rate of 20%. There's one more thing to keep in mind, and that's the net investment income tax, or NIIT. This is an extra 3.8% tax that hits higher earners on their investment income. For 2026, this tax kicks in if your modified adjusted gross income is over $200,000 for single filers or $250,000 for married couples filing taxes jointly. For the strategies we're talking about today, we're going to stay well below these limits, so we won't have to worry about it, but it's good to know it's out there. So what exactly are long-term capital gains? It's simple. When you buy an investment like a stock or an index fund and hold it for more than a year, any profit you make when you sell it is a long-term capital gain. For example, if you bought a share of an S&P 500 index fund for $100 and sold it 12 months later for $120, that $20 profit is a long-term capital gain. This also applies to qualified dividends, which are payments you get from certain stocks, mutual funds, and ETFs just for owning them. And if you hold these stocks for a specific period, the dividends are taxed at the same low long-term rates. And I'm going to make a video about that in the future, so be sure to subscribe if you haven't done already. Now, it's really important to understand what this does not apply to. We're not talking about your retirement accounts here. Any money you pull out of a traditional 401k, a traditional TSP, or a traditional IRA is taxed as ordinary income at your regular higher tax rates. And this tax-free strategy is specifically for your after-tax investments in a taxable brokerage account. So how does this all work in the real world? Let's walk through an example for a single filer. And let's say you have done an amazing job saving and you've got $2 million in your brokerage account by the time you're 50. You have achieved a certain level of financial independence. So you decide to pull the plug on work and retire early. You don't have a pension yet, and you're not touching your 401k. You decide to withdraw $80,000 for the year to live on. Now, here's the key. That $80,000 you pull out is not all profit. It's a mix of your original investment, the principal, and the gains it has earned over the years. Let's say for this withdrawal, $20,000 is your principal and $60,000 is long-term capital gains. You never ever get taxed on your principal because you already paid taxes on that money before you invested it. So the only income the IRS sees is that $60,000 in capital gains. Next, you get to take the standard deduction. For 2026, the standard deduction for a single filer is $16,100. So you take your $60,000 in gains and subtract the 16,100 in standard deduction. And that leaves you with a taxable income of 43,900. And what's the tax rate for a single filer with a taxable income of 43,900 in long-term capital gains? That's right. It's 0%. Because that number is below the $49,450 threshold, you pay absolutely no federal income tax on that money. You just live on $80,000 for the year, completely tax-free. But keep in mind that depending on where you live, you may still have to pay the state income tax on the long-term capital gains. California, for example, taxes capital gains at the same rates as income for up to 14.4%. At the same time, states like Nevada do not impose income taxes on long-term capital gains. To put it another way, you could have up to $49,450 in long-term capital gains, and then you get to stack the 16,100 standard deduction on top of that. And that means you could realize up to $65,550 in gains for the year before you even begin to pay a single dollar in taxes. And once you go over that, then you will start paying the 15% rate. And the best part is, these numbers will keep going up every year with inflation. And it's only a matter of time before we see that 0% threshold hit $50,000 or more. Now, let's look at how this works for married couples. And it's the same strategy, but the numbers are even better because married filers get a higher 0% tax threshold, essentially doubling what single filers get. So let's say you and your spouse have $3 million in a taxable brokerage account and you decide to retire early, living what some people call a chubby fire lifestyle. And you decide on a 5% withdrawal rate, which gives you $150,000 a year to live on. Again, that $150,000 is not all profit. And let's say $20,000 of it is your principal and $130,000 of it is long-term capital gains. And just like before, you don't get taxed on the principal. And as a married couple filing taxes jointly, your standard deduction in 2026 is $32,200. So you take your $130,000 in capital gains and subtract the $32,200 in standard deduction. And that leaves you with a taxable income of $97,800 in long-term capital gains. And what's the 0% tax threshold for married couples in 2026? It's $98,900. So your $97,800 in taxable income falls just under that line, which means the $130,000 in gains you took out is completely tax-free. So as a married couple, you could have up to $98,900 in long-term capital gains plus the $32,200 in standard deduction. And that's a total of $131,100 you could realize in gains before paying any federal income tax. And just remember that not every dollar you pull out is profit. I have stocks and index funds in my own account that I bought with a $1,000 principal that now have over $5,000 in gains. And it's all about time when it comes to investing. But what if you have other income like a pension? This is where it gets a little more complicated, but the strategy is still powerful. And let's say you're single, 55 years old, and retired early. You've got a pension that pays you a solid $30,000 a year, and you start withdrawing another $40,000 a year from your traditional 401k. To round things out, you want to take an additional $40,000 a year from your taxable brokerage account, which is all in long-term capital gains. When you add it all up, you're looking at a total income of $110,000 a year in your early retirement. The question is, how does the IRS look at these three very different buckets of money? And it's not as simple as just lumping it all together. And understanding the difference is key to keeping your tax bill very low. And here's how the IRS look at that. Your traditional 401k money is taxed as ordinary income. The same goes for your pension. So your $30,000 pension and your $40,000 traditional 401k withdrawal are added together for a total of $70,000 in ordinary income. So you're going to subtract the standard deduction of $16,100 as a single individual from $70,000, and that's going to give you the taxable income of $53,900. Using the new 2026 income tax brackets, your first $12,400 is going to be taxed at 10% or $1,240 in taxes. And the next $38,000 you earn from your pension and 401k will be taxed at 12% or $4,560. The remaining $3,500 will be taxed at 22% or $770 in total taxes in this 22% bracket. So the total ordinary income tax you owe for your $30,000 pension and $40,000 in 401k as a 55-year-old is going to be $6,570. And that's about $547.50 per month in federal income tax. And keep in mind that I'm not including any of the state income tax in my calculation. But your after-tax investments are treated differently. That $70,000 of ordinary income fills up your standard deduction and the lower tax brackets first. So if you're single, that $53,900 of taxable income after the standard deductions has already pushed you past the 0% capital gains threshold, which is $49,450. That means your $40,000 in capital gains will be taxed at 15%. So you're going to multiply $40,000 in long-term capital gains from your taxable brokerage account by 15%, and that gives you $6,000. And when I combine the capital gains tax for $6,000 and the ordinary income tax for $6,570, you're going to have a total tax bill of $12,570. Your taxes are still significantly low because you see how it's only 15% for your long-term capital gains, right? So if you divide $12,570 by $110,000 in total income, your effective tax rate is only 11.4%. If you didn't have a brokerage account, that extra $40,000 would have been taxed at 22% instead of 15% at $8,800. And that's a total tax saving of $2,800 annually. Do you now see why tax diversification is so important in retirement? This is why. Now, getting a pension at 55 is not as common as it used to be, but it's a reality for a lot of guys who have long careers in public service. This scenario will most likely apply to you if you have worked for the federal government, your state government, or have a full career in the military, or maybe you're a teacher with the nonprofit. And these are the kinds of jobs that still offer that reliable defined benefit pension. But honestly, you can think of this pension bucket as any form of steady taxable income. And you could just as easily be rental income from a property you own or any other consistent cash flow you have coming in during your retirement years. Now, look, I get it. Not everyone will be able to retire early with $1 million or $3 million sitting in a brokerage account, right? But I want you to think long-term and think about tax diversification. If all of your money is in a tax deferred accounts like a 401k, IRA, or TSP, then when you start taking withdrawals, every dollar counts as taxable income. And once you hit 73 or 75, depending on when you were born, those required minimum distributions are going to force you to take out money whether you need it or not. But if you've also built up a taxable brokerage account on the side, you will have more flexibility and you can withdraw from that account during early retirement, stay under the 0% bracket, and let your tax deferred accounts like your traditional 401k or TSP and tax-free accounts like your Roth 401k or Roth IRA grow a little more or a little bit longer. And you have the options to convert your traditional 401k or traditional TSP over to your Roth accounts when your taxes are still low. And that's the kind of planning that gives you options. So here's the key takeaway. The IRS just confirmed that in 2026, single filers can earn up to $49,450 and married couples can earn up to $98,900 in taxable income, all taxed at 0% for long-term capital gains, with a standard deduction of $16,100 for singles and $32,200 for married couples. That gives you even more breathing room to keep your income tax-free. And combine that with smart withdrawals from your brokerage account, and you can literally retire early and live on your investments without paying a penny in federal income tax, and at least until your taxable income climbs above those thresholds. So yeah, while everyone's out there stressing about tax rates and inflation, you could quietly build a setup that lets you live comfortably with a predictable low tax income. And if you ever get pushback from people who think this is not possible, just smile, because the truth is, it's not a loophole, it's a strategy. And that's what separates people who just retire from those who retire well. And this has been another piece of the video, and I hope you got a lot out of it.